Every share of stock you own isn't actually yours. Not legally, not technically. You think you own it. Your brokerage statement says you own it. But the shares sit in something called street name, registered to your broker, not you. And while they sit there, Wall Street lends them out to short sellers, to hedge funds, without asking permission, without paying you. Your shares are collateral in a system designed to bet against the very stocks you're trying to profit from. They use your property to destroy your investment. And it's completely legal, has been for 50 years, since 1973 when the Depository Trust Company took control of stock ownership in America. But there's a loophole, a mechanism built into the system that Wall Street desperately hopes you never discover. It's called direct registration, DRS. And if enough Americans used it, if enough shareholders pulled their stocks out of street name and registered them directly, the entire short-selling apparatus would collapse. Wall Street would lose its ammunition. The game would end, which is why they've spent decades making sure you don't know this exists. When you buy a stock through any broker, Fidelity, Charles Schwab, Robinhood, Tudo Americano, the shares don't get registered in your name, they get registered in the broker's name. You're the beneficial owner, which means you get the economic benefit. Dividends, price appreciation, but not actual ownership. The broker holds legal title, and that legal title allows them to do something most investors don't realize. They lend your shares to short sellers. Hedge funds that want to bet the stock will fall. Those funds borrow your shares, sell them immediately, wait for the price to drop, buy them back cheaper, return them, and pocket the difference. Your broker facilitates this, gets a small fee, and you get nothing. Not asked, not compensated. Your property used against your interest. But here's what makes this truly insidious. When shares are lent out like this, there can be more shares trading than actually exists. If a company issued 1 million shares, but those shares are lent and relent multiple times, suddenly 5 million shares might be trading. Phantom shares, IOUs, all betting against the company, driving the price down through artificial supply. This isn't conspiracy. It's documented, called legal in the United States, and it's destroying companies while enriching hedge funds. The system wasn't always like this. Before 1970, stock certificates were physical. You bought shares, you received a certificate with your name on it, actual paper proving ownership if you wanted to sell. You physically delivered the certificate to a buyer. This was slow, expensive, inefficient. As trading volumes exploded in the 60s, Wall Street couldn't keep up. The paperwork crisis, too many certificates, too many transfers, brokers were drowning. So in 1973, the Depository Trust Company was created, a central clearinghouse. Instead of moving certificates, everything would be electronic. Shares would be held in street name. Brokers would update ledgers. Trading became instant, efficient, profitable. But something fundamental changed. Individual ownership became theoretical. You owned shares in name only. The broker controlled the actual certificate. Or rather, the DTC controlled them. And the broker controlled your claim. You became a creditor, not an owner. The distinction seems technical until you realize what it enables. Short selling existed before street name, but it was limited, constrained by the need to actually borrow physical certificates. There was friction, cost, risk, but once shares became electronic entries, once the DTC held everything, borrowing became effortless. A hedge fund calls a broker, wants to short a stock, the broker checks its inventory. All the shares held in street name for customers, lends them out, often repeatedly, the same shares lent to multiple parties, creating synthetic positions, naked short selling when they don't even bother locating shares to borrow first. Just sell shares that don't exist. Create IOUs. The system allows it because settlement takes 2 days. In those 2 days, anything can happen. Shares get located or don't. Failures to deliver pile up. The SEC tracks this, publishes reports. Some stocks have more shares sold short than exist in the entire float. Mathematically impossible under legitimate ownership. Completely possible under street name. This remained hidden for decades. Retail investors didn't understand the mechanics, didn't know shares were being lent, didn't realize the system allowed phantom shares. But in January 2020-1 ... something broke. A stock called GameStop became the center of a battle. Retail investors on Reddit realized the company was shorted over 100% of the float. More shares sold short than existed. Hedge funds were naked shorting, betting GameStop would go bankrupt. Retail bought shares. The price rose. Hedge funds needed to buy back shares to close positions, but retail wouldn't sell. The price exploded from $20 to $483 in weeks. Hedge funds lost billions. One hedge fund, Melvin Capital, lost so much they needed a bailout. And in the aftermath, retail investors started asking questions. How were there more shares short than existed? How was naked shorting allowed? Who was lending shares? And they discovered that brokers were lending their shares to the very hedge funds betting against them. The outrage was immediate. But more importantly, someone discovered the alternative. If this is making you angry, if you're starting to see how the system uses your property against you, then you need to understand what comes next. Subscribe now, because what happened after exposed this might be the most important financial movement in 50 years, and Wall Street is terrified. Direct registration system, DRS, it's been part of stock ownership since street name began. A way for investors to register shares directly with the company's transfer agent, removing them from broker control, from street name, from the lending pool. When you DRS shares, they're registered in your name with a transfer agent, Computershare, Equiniti, American Stock Transfer. These agents maintain the official shareholder registry. When shares are registered there, they can't be lent out. Can't be used for short selling. They're locked. Yours. Actually yours. Not beneficially, not theoretically, legally, directly, the way it was before 1973. And this option has always existed. Buried in broker procedures, never advertised. Never encouraged, because every share moved to DRS is one less share Wall Street can use, one less tool for manipulation, one less piece of ammunition for short selling. After GameStop's January squeeze ... someone on Reddit posted about DRS, explained how it worked, showed the process, and retail investors started transferring shares. Slowly at first, then accelerating. By the end of 2021, millions of GameStop shares were in DRS removed from the DTC, locked in individual names. The company started reporting the numbers in quarterly filings. Shareholders wanted transparency, wanted to know how many shares were being pulled from the system. The number kept growing. By 2020-3 ... over 75 million shares. More than half the free float, indirect registration, unavailable for lending. And something interesting happened. The stock became harder to borrow fees increased. Short interest couldn't grow despite massive downward pressure. The supply of lendable shares was shrinking, not because fewer people were holding, but because more people were registering, taking ownership, removing their property from Wall Street's grasp. Wall Street's response was predictable. First, ... silence. Mainstream financial media didn't cover DRS, didn't explain what was happening, pretended it wasn't significant. Then, ... when the numbers became too large to ignore ... mockery, articles calling it a cult, saying DRS was pointless, that it wouldn't impact anything, that retail investors were stupid for thinking they could challenge the system. Then, when mockery didn't stop the momentum ... obstacles, brokers made DRS transfers difficult, required phone calls instead of online requests, added fees, took weeks to process transfers that should take days. Customer service representatives gave wrong information, said DRS wasn't available, said it would hurt investors, said shares would be harder to sell. All false, all designed to discourage, because every share removed from street name is a share they can't use, can't lend, can't leverage for their own profit. But the most revealing response came from broker-dealers themselves. When investors requested DRS transfers, brokers had to actually locate the shares, had to prove they existed, and sometimes they couldn't. Failures to deliver shares that showed in customer accounts but didn't actually exist in the broker's custody, IOUs, synthetic positions, when forced to transfer. Brokers had to buy shares in the market to deliver to the transfer agent, creating buying pressure, pushing prices up. Some transfers took 6 weeks, not because of processing time, because brokers didn't have the shares, had to scramble to acquire them. This proved what retail suspected: the shares in your account might not exist, might be entries on a ledger backed by nothing, until you try to move them. Then suddenly reality matters. Then suddenly they have to find real shares, and if they can't, you discover you never owned anything but a promise. Do you see the power of this? If enough shareholders EEV, enough demand, actual ownership, the illusion collapses, the phantom shares get exposed. The naked short positions become untenable, because you can't lend shares that aren't in the lending pool. Can't create synthetic positions without inventory. The entire derivatives market built on top of stock lending. The options market, the swap agreements, the leveraged bets, all of it requires a pool of borrowable shares. Remove enough shares from that pool, and the leverage unwinds. Forcibly, violently, catastrophically for those holding short positions. This is what Wall Street fears. Not that retail will buy and hold. They can handle that. They profit from volatility, from transaction fees, from lending shares back and forth. But DRS removes shares from the game entirely, permanently, irreversibly. And if the practice spreads beyond GameStop, if other stocks see mass DRS movements, if investors across America wake up and decide to take actual ownership, the entire short-selling business madaldais. The scale of what this reveals is staggering. According to SEC data, the securities lending market generates approximately $10 billion annually in revenue for brokers and prime brokers, $10 billion, from lending shares they don't own that belong to customers without compensation, without permission. It's such an accepted practice that it's built into customer agreements, that fine print nobody reads. The clause saying your broker can lend your shares that you implicitly agreed to by opening an account. Most investors don't know. Those who know, don't care, don't understand the implications. But what if they did? What if millions of shareholders suddenly demanded their shares back, requested DRS transfers, removed their property from the lending pool? That $10 billion business evaporates. The collateral for trillions in derivatives disappears. The short positions built on borrowed shares become impossible to maintain. The system that's functioned smoothly for 50 years, breaks, and there's legal precedent showing why this matters. In 1970-7, a stock called Boston Celtics was heavily shorted, more than 100% of the float. Retail investors realized this, started buying shares, demanding physical certificates, removing them from broker custody. The short squeeze that resulted was so severe that short sellers literally couldn't find shares to cover. The stock price went vertical. Some shorts never closed. Took years to resolve. The Boston Celtics squeeze happened because investors demanded actual ownership, physical certificates. The modern equivalent is DREs, and Wall Street remembers what happened, knows what's possible, which is why they've structured the entire system to make DRS obscure, inconvenient, intimidating, why they never mention it, why financial advisors don't recommend it, why brokers discourage it. Because if it became standard practice, if investors defaulted to direct ownership instead of street name, 50 years of financial engineering collapses. But here's what should terrify anyone paying attention. The shares in street name aren't just being lent for short selling. They're collateral in a rehypothecation chain. Your shares sit at your broker. The broker pledges them as collateral for margin loans from a prime broker. The prime broker pledges them as collateral for loans from a The clearinghouse uses them as collateral in repo markets. The same shares collateralizing multiple loans, leveraged up to 50 times in some estimates. One share registered in street name becomes 50 shares of collateral throughout the system. This is Lego, this is standard, and it means the financial system is leveraged on assets that don't actually exist in the quantities being claimed. It's fractional reserve banking, but for stocks, and if enough shares get removed through DR, if the collateral shrinks, the leverage can't be maintained, margin calls cascade, positions unwind, and the counterparty risk reveals itself. Who owes what to whom when the shares don't exist? If you're understanding that the entire stock market is built on a foundation of shares that might not exist in the quantities being traded, if you're realizing that your broker is using your property as collateral for bets you've never approved, if you see that Wall Street's fear isn't about your investment choices, but about your decision to take actual ownership, then you need to know what we're revealing next. Subscribe now, because the next investigation shows what happens when this system breaks. The flash crash of 2010, the treasury market freeze of 2020, the moments when leverage exceeds reality and everything nearly collapsed, and how close we are to the next one. Because every share in DRS is one less piece holding up a quadrillion-dollar derivatives market. The numbers tell the story. As of December 2023, over 75 million GameStop shares were in DRS, removed from the DTC. But GameStop's total shares outstanding is only about 300 million. And the free float shares not held by insiders ... is around 200 million, which means over 37% of the free float is in direct registration, unavailable for lending, locked. And the company keeps reporting this number growing every quarter. More shares, more investors opting out of street name, choosing ownership over convenience. But here's where it gets interesting. GameStop isn't the only stock seeing DRS movement. AMC Entertainment, Bed Bath & Beyond before bankruptcy, dozens of heavily shorted stocks. Retail investors across multiple securities are discovering DRS, starting to pull shares. Not in massive quantities yet, but enough to be noticed. Enough that transfer agents are reporting increased volume, enough that some brokers are updating policies, and enough that financial media is finally being forced to address it, usually to discourage it, to explain why it's pointless, why investors shouldn't bother. But the fact they're addressing it at all means they're worried, because the mathematics are simple. If 50% of a company's float gets half the shares are permanently unavailable for borrowing. Short selling becomes limited, constrained, expensive. If 75% gets DRSD, short selling becomes nearly impossible. Borrow, fees, spike, failures to deliver, multiply. The price becomes unpredictable, volatile, resistant to manipulation. And if 100% of the float gets locked, if every available share is in direct registration, you can't short the stock at all. Can't borrow what doesn't exist in the pool. This has never happened to a major company. Never been attempted on this scale. But GameStop is proving it's possible. Slowly, methodically, through millions of retail investors making individual decisions. And Wall Street can't stop it, can't make it illegal, can't prevent shareholders from requesting direct registration. Because it's there, right? Built into the system. A feature they left in place thinking nobody would use it, assuming convenience would always trump ownership. And they were right for 50 years, until they weren't. The broader implications are nuclear. The entire ETF market is built on street name ownership and share lending. When you buy an ETF, the fund doesn't actually own all the underlying stocks. It uses representative sampling and derivatives, and the shares it does own are lent out constantly to generate additional returns. If those shares started getting DRSD by individuals, the ETF structure becomes unstable. Index funds, passive investing, the entire modern portfolio theory apparatus. All of it assumes shares will remain in street name, available for lending. Liquid fungible DRS breaks that assumption. Makes shares illiquid by choice, removes them from the system permanently. And if the practice spreads, if it becomes a movement, if investors decide they'd rather own their property than facilitate Wall Street's leverage, the ETF market faces a crisis. Not immediately, not dramatically, but slowly, erosively, as the pool of lendable shares shrinks, as liquidity decreases, as the mechanisms of modern finance stop functioning smoothly. And there's historical precedent for what happens when a system built on borrowed shares collapses. The 1929 crash wasn't just a market correction. It was a leverage unwind. Shares had been lent and relent, used as collateral multiple times. Margin debt was enormous. When prices started falling, margin calls triggered forced selling, which triggered more margin calls, which triggered more selling, a death spiral. The entire market lost 89% of its value over 3 years. Not because companies lost 89% of their value, because the leverage built on borrowed shares unwound, the collateral disappeared and the debts remained. DRs in mass ... creates a similar dynamic, not immediately, but potentially, because modern markets are leveraged far beyond 19. The derivatives market is measured in most of it built on underlying collateral that's been lent multiple times, used simultaneously by multiple parties, and the collateral is street name shares. If those shares leave street name ... the leverage becomes unsupported, naked, dangerous. Wall Street knows this. The smart money understands what mass DRS represents, which is why you'll never see a broker advertise it, never see a financial advisor recommend it, never see mainstream media explain its power, because doing so would be showing investors how to break the system, how to collapse the leverage, how to force accountability. And the system doesn't want accountability, wants obfuscation, complexity, barriers between investors and true ownership, because true ownership means control, means power, means Wall Street can't use your property for their profit, can't bet against your investments with your own shares, can't maintain the leverage that's made them trillions over 50 years. DRS is the Achilles heel, the one thing they left in place thinking it didn't matter, and now they can't remove it without admitting what street name really means, without revealing that your shares aren't really yours, without confessing that the entire system is built on borrowed assets that belong to someone else. But here's the cruelest irony. Most investors won't DRS even after learning about it. Too inconvenient, too complicated, too different from how everyone else does it. The same inertia that keeps people in street name, that keeps them accepting that their broker lends their shares, that keeps them participating in their own exploitation. Because the system is designed for convenience, for frictionless transactions. And direct ownership has friction, has steps, requires action. So most will read this and think it's interesting, or think it's exaggerated, or think someone else will do it. And Wall Street is counting on that, counting on inertia, on apathy, on the assumption that even informed investors will choose convenience over control. And they're probably right for most people. But they don't need most people. They just need enough people. Enough shares to maintain the lending pool, enough collateral to support the leverage, and if that tips ... if critical mass is reached, if DRS becomes default instead of exception, then what? Wake up. See the structure? Your shares aren't yours. They're street name, beneficially owned but not legally controlled, lent out without permission, used as collateral without compensation, leveraged 50 times over in a system that counts on you never asking for them back. DRS exists, has always existed. Legal. Mechanism to take direct ownership, to register shares in your name, to remove them from Wall Street's pool permanently. GameStop has proven it works. 75 million shares removed, billions of dollars in short ammunition eliminated, and Wall Street is terrified this becomes standard. Terrified investors wake up. Terrified the leverage collapses under the weight of people simply demanding what's theirs. This isn't financial advice. This is information they hope you never discover. Loophole they left open thinking it didn't matter. But if Americans knew ... if enough acted, if direct ownership became the norm, Wall Street wouldn't just panic. It would collapse. And your shares would finally be yours.